HDFC Bank investors had two nightmarish sessions as the shares of India's largest private sector lender spiraled 11.4% lower in 2 days. On the bourses, the stock plunged from a level of 1,680 rupees to 1,485 rupees within 2 sessions, wiping off 1.43 trillion rupees worth of investor wealth. Nervousness on the counter emerged after the lender's December quarter results painted a sluggish margin and deposit growth outlook.
The NIMs were around 3.6%, which is quite below our expectation. The higher CDR ratio of 110% and a regulatory LCR is also at 110% are the cause of concern. The lower LCR and a slower deposit growth may limit the NIMs expansion going forward.
During the October to December quarter, HDFC Bank's total deposits rose less than 2% quarter on quarter. The average quarterly net deposit for the 9 months of FY24 stood at 63,600 crore rupees, lower than the target of 1 trillion rupees. Weak deposit growth pushed the loan-to-deposit ratio to 110% from 107% in the September quarter. Besides, it used its liquidity buffer to support incremental loan growth, thereby pushing liquidity coverage ratio to 110% from 121% quarter on quarter. With loan-to-deposit ratio rising over 100%, analysts believe it could be a tightrope walk for HDFC Bank. According to Kotak Institutional Equities, the bank has struggled to build the drivers of earnings since its merger with HDFC Limited. Post this quarter, the levers have been fewer. While we expect the net interest margin to have bottomed out, it has taken a much longer time to settle. The stock on its part plunged over 8% on January 17, clocking its sharpest one-day fall in nearly 4 years. Its previous worst fall was registered on March 23, 2020, when it had fallen 12.6%. With this, the stock has broken below the 200 daily moving average level.
For the third time in the last 3 months, HDFC Bank has dipped below its 200 DMA. Just like the last 2 occasions, the stock may consolidate in the near term with a negative bias. On the downside, the stock has strong support around Rs 1450, below which it can slide to Rs 1370 odd levels. On the upside, the stock is expected to face resistance around Rs 1575 and Rs 1610.
In summary, analysts believe that given the continued systemic tightness in liquidity and HDFC Bank's high ask rate concerning deposit accretion, the improvement in the lender's margins will only be gradual. On January 19, market action may remain stock-specific amid a slew of Q3 earnings. Reliance Industries, Hindustan Unilever, Paytm and Suntech Realty are some of the prominent firms due to report their results today.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.